Hola amigos, bienvenidos a Visión Periférica. This is our third English episode, and today I am joined by Chase Chandler. He is the head of Canterbury-Tollgate, which is an investment fund based in Tennessee. Correct me if this is wrong. Uh, First of all, how are you this evening, Chase?
I'm good, Pedro. Thanks.
Okay, yeah,
Thanks for having me too.
Yeah, thank you so much for being here. So I want to ask you first of all, how did you get started on investing, like investments specifically?
Well, I started in the industry right out of college, and or actually, when I was still in school. First job was in, or my first experience with the financial services world was in London. I was finishing college, and I was there for a couple months, and then I started the goal is to be an analyst or a junior analyst or something, whatever, to get my foot in the door. But I didn't go to Ivy League school. I wasn't a top notch. I was a terrible student. I was not focused on. I didn't go to college for the education. I went to college for other reasons, playing baseball and you know girls and all that stuff. And education was not even on my radar until my last couple of years. I wasn't gonna get a good job, and this was 06, 07. So then things went south, and I basically got into wealth management, insurance. I worked for an insurance company for 5 years, uh, from 07 to 2012, and did all sorts of things, insurance and wealth management analysis, and kind of got a little bit of experience in a bunch of different areas. And then I made the bold decision to start a firm in 2012. I was 26 or 27. I was 26 when I started it, and so we also tried to do everything, and which was really not smart. Doing wealth management, investing. We started a fund in 2013. We did insurance. We did like retirement planning, all that jazz. And so basically through that process, I learned I was pretty good at certain things. And we had a big team. We grew to have a pretty big team. We were pretty good at certain things, but I wasn't good at lots of things, like managing a big business, or a big and growing business, and scaling it, and all the infrastructure that's involved, and the communication side wasn't necessarily my strong suit. So I learned a lot of what not to do, and kind of over time got to a point where, relatively quickly, got to a point where I could do what I thought was best. So that involves just investing and reading a lot and staying up to date with what's going on, thinking about different philosophies, and then obviously the library stuff, which is how we came across each other.
Yeah. So it's funny that you say that you don't like to study. Something I
No, I do
noticed.
now. I do now. I didn't then. So I learned
Okay.
everything. It's a terrible. I went to three schools, or the best education, the most eruditious thing that I have done is Rory. So I imagine, I just have this sense that it's kind of like what American universities or any university was when they were founded initially. Like their purpose was to bring people together and talk about important ideas, right?
Mhm.
And physics, the sciences, philosophy. So, and then they devolved over time to what they are now, for the most part. I mean, there's some good schools out there here and there, but for the most part, they devolved. And so Rory is the best. But I did a bunch of stuff after that, into grad school, to a few grad schools, and
Yeah. So yeah, and the reason I mentioned that is I noticed in your resume that you are a CFA charter holder and FRM and CFP. What was your experience like, getting all these certifications? Was it a ton of work? Was it easy for you?
No, it wasn't easy. It was. I don't know if you want to. I'll try to give the cordial or the diplomatic answer. it wasn't easy, but it was it was it wasn't, you know, certain parts were really hard. Certain parts, like the CFA, the level 3 for the CFA for me was the hardest. Level 2 is the hardest for most people, but I did well on that and passed it the first time. Level 3 was hard. The FRM was most interesting. That's more quantitatively oriented. Um, lots of value risk calculations there. What you notice in all these programs is there's just way too much theory, but you know, I don't know how they get around it. They have to, I guess, test you on something. So
Yeah.
What you learn there and then what's in the real world don't exactly cross over. I think the thing that I found is, most people I come across at a certain point, they've finished grad school or whatever, and they're just kind of doing what they do, and the main part of their learning is over. And I was the exact opposite. I had a lot to catch up on after undergrad. like you'd be surprised how much, if I told you how much I had to catch up on. My last course in undergrad was Comp 2, English 2, which you're supposed to take as like your first or your second semester as a freshman. So I put off a lot of the basics, and but I kept going after that. So I just didn't stop. So I really got into reading. I spend probably most of my time reading, and so all sorts of things.
So a little context for people. People may not know what RURI is. This refers to the Real World Risk Institute, which is a 1 week course held by Nassim Taleb. It's usually held in New York. It's usually held in New York, but recently they've been doing it online. So a little like one more question on this. Something that Alfredo Morales, I don't know if you've met him, but he's also a complexity person. So he said something that I quite liked, which is that classical literature, all of it seems to be consistent with the principles of complexity. And so the way I see it, what Nassim Taleb has done really is bring what people would call ancestral knowledge or like common sense. He has brought all of that to the field of quantitative finance, because it seems to me that the world of human affairs becomes increasingly complicated, but education makes people increasingly more simplistic and more linear thinking. And so I guess my question for you is, I also noticed that, you read Benjamin Franklin, not only investors like Charlie Munger, but, you also have read Hamilton. Do you think that, reading philosophy or history in a way has informed the way that you think? Or is this something that you mostly do to satisfy curiosity? Like, how do you think of this?
Yeah, well, it started because I just wanted to learn, and history is by far just, you learn more in a good history book, than even though there's lots of stuff that's unclear or not knowable, or different people have different opinions on things that happen. But you learn more about. I really like biographies. You learn more from like Cherno's biographies, John D. Rockefeller, Hamilton, Ulysses S. Grant, and J.P. Morgan, and I learn more from those than I think you could in any kind of a business course or whatever, because you just learn how people act, and you start to see. Katharine Graham's is another good one. Buffett's Snowball about Buffett is good. You just start to see these patterns in human tendency, like it's. So I had a conversation with Trushank. We mentioned Trushank earlier. He's an instructor, very good friend, and we had a conversation a while back about universal computational universality, right? Stephen Wolfram's idea. Mm-hmm. So Munger's thing about the lattice work is really important, right? So that's you bring in the history, the philosophy, the physics, the biology, the all of that. I think all of those complexity encompasses basically all of those, right? In some sense, but Trushank and I were talking about computational universality, which was developed by Stephen Wolfram, and you kind of see that in history and in the biographies. You see that people have these tendencies, and if they get this lattice work concept, which is like you learn what works The way Munger says it is you learn what works and do it, and then do it again, right? So you figure out what works and you do it, figure out what doesn't work and you don't do it. So, and there's you think about it, there's not that much that we can know. So there's just a handful of things that are important to kind of realize, and you can see that in real time with contemporaries and people that we know, and in history with different situations, how things kind of turn out for people who kind of get it and people who kind of don't. And it's, so that was kind of an incidental thing that I got out of reading. And then then it turned into more of curiosity after that, to answer your question. So I got into like different things that really have not a lot to do with complexity sciences or investing or finance or anything like that, but are just fun to read, like Wyatt Earp and Wild Bill biographies and stuff like that. So
yeah, okay. So about Canterbury-Tollgate, why is it called that?
So basically the firm I started initially was Chandler Advisors in 2012, and my whole, my heart and soul were tied into it, and I was the founder and everybody wanted to talk to me. And at one point we had like 25 employees and 4 offices, and it's just a lot to manage. And so when we ended up merging with a group in Chicago, and I worked with that group for 1 year as the co-chief investment officer, and then went back out on my own. And the goal going back on my own was just to focus on investing, just to be able to do what I thought was best on the investing side and the hedging side, and not have any of the distractions that are involved in hiring and firing, at least not initially, hiring and firing, and the infrastructure that you have to deal with to have, lots of employees and people and stuff like that. So I moved into I just wanted not to have to think about anything. So I moved into a suburb called Canterbury, and a neighborhood, and then the neighborhood right next to us is Tollgate. So I was like, oh, I'll just use that.
Okay, no, that's
so
nice.
It literally means nothing. Yeah.
Okay, no, I mean, I thought it could be
an agnostic term.
Okay, I thought it could be a Chaucer reference. Okay.
No,
cool.
no. I do get that a lot though.
Yeah. So
no, it literally has no meaning, because so Spitznagel, I heard him say one time, I think in a Bloomberg interview, he said, the beauty of what he does, what the universe does, is they get to be agnostic about market direction. They don't have to know if it's going to go up or down. And that's kind of how I named the firm. I just wanted to be agnostic about it. I didn't want to have any emotional tie into, all these people talk, you got to have your purpose and your why and your all that. And it is important, but it's mostly just fluff. And these seems like everybody and their brother has some sort of cool name. So I figured I'd be one that didn't.
Yeah. Yeah. There's no like name of a mountain or I don't know, like a Greek letter.
Right.
So, okay. So, discussing a little bit your investment philosophy, I quite like what you said, which is in general, you can be, or you should be agnostic to the direction of the market, but this goes against the way people tend to plan, right? Because now, people tend to work in very big corporations and government agencies that, the mindset that they have is that in a way, the way you should navigate the world is make a forecast and predict whatever you think is going to happen. And then you sort of optimize around what you think should happen. Right. And so when someone hears something like, oh, we're direction agnostic, or I'm investing, but I'm not trying to predict the future. How would you explain to someone, how to invest and how to expose yourself to the market when, you're not really making a bet on what you think is going to happen?
Yeah, it's a hard question to answer. That is the question that is, I've thought about a lot. How do you answer it? And it's basically, so people get confused with they feel like they have to pick one side or the other, right? It's either this or it's that. And it's really both. Like the market is both efficient and not efficient. And so you
how so? I'm sorry.
So as a investor, so we're integrating the kind of value and quality investment approach, where we're looking for good companies that are going to do well over time and trying to buy them at reasonable prices, or at prices below what we think the value is or will be, and then we're hedging, and I'm not like super great at either, but I'm good enough at both to be satisfactory, right? So Universa is the pioneer of tail hedging, and they're the best in the world at it. And there's obviously you have Buffett Munger, and you have a lot of good or pretty good value type investors that follow that approach. But merging the two is unique. I haven't met anybody who kind of gets. There's a lot of people who follow one side or the other who just like don't get the other side. So anyway, as a value and quality kind of investor, we're not saying that the market's inefficient. We're saying that it's inefficient when we buy. That's the statement that we're making. That statement you're making anytime you do anything. Mm-hmm. Anytime you buy anything, you're saying that this investment has value for whatever reasons, and then the market's going to realize that later. So it's going to become efficient eventually, right? If it doesn't, then and then sometimes it plays in your favor, or you have some randomness and luck or lack of luck involved here and there. But over time, you're dealing with randomness, right? Mm-hmm. You're trying to figure out what's real in a sea of random movements. But what all the academics do is they mistake randomness for efficiency, or they think that it's random, therefore it's efficient, which that doesn't follow. So it just, they're not the same thing.
Yeah, no, that's a great way to put it. Yeah, because basically, I mean, I wouldn't say that in general there's arbitrage. I mean, I think that there is room for arbitrage, but those opportunities are low. You're more in search for mispricings in general, right? And so basically the idea is, as time moves forward, if you systematically expose yourself to mispriced, underpriced assets, eventually, that mispricing is going to manifest itself, and that's basically how you generate returns.
Yeah, we're betting that. So basically, we're betting that if things are going to be okay enough in markets, and then we have a drag on the hedging side, most of the time that's how it works. And then when things get rough, mm-hmm. they get rough in a hurry. So that was March of 2020. Or when there's this chance that they might get rough. So you have these little events here and there. August of 2015 was one, Chinese devaluation, the Greek default. And then you had February of 18. I can't remember what happened in February of 18, but the market opened up like down 5 or 10% one day. But you really haven't had a lot in the past few years. So obviously 9/11 was one. There were 2 or 3 in 07, 08, 09 time period. But it's like the air doesn't, you don't have a slow leak in markets. It's like things are okay to pretty good, and then, or they're awful, right? Then when they go awful, when they go bad fast. Mm-hmm. Howard Marks says the air goes out of the balloon a lot faster than it goes in. So yeah. That's kind of the premise that we have. And you're right. Most people are just naturally set up to gain when things go up and lose when things go down. Or if they're short, it's more of a linear relationship. If they're short, then it's the opposite. And neither one of those in and of themselves, I don't think are the ideal strategy, because eventually things do go south, and or not eventually, every once in a while they go south, and eventually they go south in a bad way, and it can be prolonged, right? So that's the Great Depression. That's Europe in the first part of the 20th century. So the Ottoman Empire was the largest economy in the world in the late 19th century, right? So, or obviously England was dominant, and then things change. So people usually aren't ready for that when it happens.
So I think one of the problems in the United States is equities in the US have had an amazing performance historically compared to other countries. Like in places like Venezuela or Argentina, like if you invested your money in the stock market, like you would have lost all your money. And so I think people have this idea that if you put all your money in the S&P 500, it'll grow at 8% until the day you retire, right? And so like people have an amazing confidence in the market. And personally, I don't feel very safe doing that because we live in times where, we know that the government is stimulating the economy, and in a way that's helping the market grow because there's an asset inflation. And so one of the reasons I wanted to have you here is, for someone who wants to invest and, maybe they don't have enough that they can invest in Canterbury-Tollgate. I wanted to ask you a few questions about, kind of general investment, do's and don'ts. And more than getting a recipe from you or, for you to tell us exactly what people should do, I think it's better if you share your perspective, because I think people would benefit from, basically understanding how you look at some aspects of investing. So first of all, do you know about like the Motley Fool? Like
Yeah.
there's a number of services where, you can buy your own research on what stocks might go up, etc. Do you have any thoughts on those services for people who want to invest in individual stocks?
Yeah, I don't really have like a strong opinion. I think it's that sometimes they're good, most of the time they're not. Motley Fool has been one that's got they've got a longer kind of history, and they do some fundamental research, and they do a lot of like kind of market structure or you could call it technical analysis, but it's really like order flow analysis. They're not really like valuation investors per se. Like they're saying, we think a bunch of people are going to start buying this stock, and so that'll work until it doesn't, right? It's gone, it's done okay. But if you really look at the underlying results of all those deals, it's kind of like, and I know this is a little bit cliche, but and they probably have a compelling answer for it, but it's like, if you're so good at this, why are you selling it as a service instead of just doing it yourself? So what's that? And there is no answer for that. Whatever they kind of, compelling retort they have, it's going to be it's not going to be substantial. I would submit, because if you can make 20% a year or 30% a year or whatever, even 15% a year annualized over 20, 30 years, there's no way a newsletter service is going to be the way you want to go. So they often say, well, we just want to help people. It's like, okay, I don't know what that means.
Okay. Yeah, no, that's fine. I mean, that's exactly how I feel. Like
it's kind of a logical. I don't like telling people. I think it's because I did it for so long, professionally, and just I guess I got in the habit of it. And telling people, I worked in wealth management space and for a while, and that's all about telling people what to do. And I just got kind of it's just usually not a good idea to tell people what to do. But I do think you can help people learn how to think. And if you just think about it, like we talked about, like Motley Fool or any, what are the incentives? What are they doing? And if you look at, it's a skin in the game component. Taleb's thing, skin in the game. So what are their incentives, and then what's their downside? And if they don't have it, if you take all the downside, they don't have any downside, then you got to be careful. I mean, it's.
Yeah. Okay. Yeah. Good answer. Okay. So, in your letter, I saw that, you talk a lot about kind of like finding companies that have, very good management, solid, like a solid business in itself. However, for most people, it's quite difficult to, find these companies. First of all, when you talk about these companies, are these publicly traded, or can you also invest in private companies?
Yeah, you could do both. We do a little. I mean, most of my stuff is in public markets.
Okay.
But I can see I've done a couple of private deals, private investments, and I could see doing that more. But eventually they're
But
different side of the same coin.
I guess my question is, if you want to buy a stock, do you get the chance to, I don't know, talk to the CEO, visit, you know what I'm saying? Because you're a big fund, right? And so, well, you're a fund, right? Like you're not an individual investor.
Not a big fund, but yes, we're a fund. Yeah.
Yeah. But so if you want to buy into a company, maybe since you're a fund, you can maybe talk to them, or like, right?
Yeah.
Like you have access to more information than, someone from their, interactive brokers.
It's not necessarily more information. It's not more information for sure. It's better insight, kind of a better understanding of how those dynamics work. So yeah, so we talk to executive CEOs and CFOs here and there. Talked to one today actually. Usually they're smaller companies because they have a greater incentive. They have people kind of I think market participants forget that prices are set by the marginal buyer, the marginal transaction. So the last transaction what sets prices. So it seems like, and I thought this for a long time, and I wrote about this. It seems like the stock market is just kind of this opaque, like not Ponzi scheme, but opaque scam where nothing really exists and everything's betting on some big promise and everything. And you have those periods, and you have these these euphoric kind of periods, but in reality there's a functional capital allocation purpose of markets, and it's if companies can in one way or another persuade or convince investors that they're worth buying and holding on to, they're going to have a lower cost of capital. And if they have a lower cost of capital, they can finance more projects, right? So that just means, if you think about it in debt terms, they have a lower interest rate, but there's also a rate for equity investing. So these smaller companies have greater incentive to talk to guys like me. We also talk to some of the bigger ones, but it usually takes more work. Not always, but usually takes more work to get to them because we're not going to move their stock price. Now, if you're BlackRock, BlackRock, or a big hedge fund like Pershing or something like that, then yeah, they have to talk to you because you can really make a dent in their share price one way or the other. So it's not more information, but it's insight. Like one of the questions I asked when I talked to him is, and I got this from a guy who's in Switzerland, who's one of the he's a very good. What's that?
Anthony Dayton?
No, he's good too. He's good.
Okay.
No, this guy's Robert. I think Robert Vinal is his name. And he actually, he's a very good value investor. And I heard him talking about at one point what he asks CEOs when he's having these meetings and CFOs. And one of the questions is, how do you make capital allocation decisions? Because when you get in these conversations, oftentimes the CEOs just talk about how great their product is and their culture is just wonderful and they're doing all these amazing things. And that's all. Let's just say for a minute, all that's true. That's great. That's wonderful. But how do you decide how to make CapEx investments, right? So how do you make those capital allocation decisions? And you'd be amazed how many times the CEOs really kind of don't have an answer. They are experts at giving some sort of roundabout answer that's tied into some childhood story about how they did this or that, and then had a tough time and started this company and all that. But it doesn't answer the question. The simple answer is, it doesn't matter how great your product is if you're not going to earn an adequate return. If you're just growing sales and you're not going to earn an adequate return on that investment, then it doesn't make sense to do. So that's what you see with a lot of the behemoths, like GE and IBM, and they just became massive. But apparently they weren't too focused on their return on invested capital or their return on incrementally invested capital. So for every dollar that they put into their net capital, what were they getting back? Amazon, on the other hand, a lot of people have different opinions on them, but Bezos has been focused on that since day one. What's the cash that's going to be generated from this decision? So that's where I go with most of the conversations.
So any thoughts on using the price to equity as a reference for purchasing a stock?
The price to EPS?
Yeah. Sorry.
Price to earnings? PE?
Yeah, price to earnings. Yeah.
Yeah, it's terrible. It doesn't make any sense. Earnings is not a real number. It's a guesstimate. So accounting is not as straightforward as that. It's accrual accounting, GAAP accounting in the U.S. and IFRS in most of the rest of the world. And so revenue is not real dollars. It's in these businesses. It's we have this contract to do this business, and we're going to get paid, next year, or even the year after, something like that. And so that's revenue. And so it comes in over time, most of it, usually. But it's not that difficult. It is truly not very difficult to kind of massage that number. So then that gets down to that's the top line of the income statement. Then you have all sorts of expenses. Some of them are cash expenses like payroll. Others are more manipulatable, more fudgeable. So like they can play with the numbers on pension expenses. They can change how they account for lease expenses. They can do depreciation timeframes.
Right.
They can do all those kinds of things that will affect the bottom line. So what matters is cash flow, and that's really the only thing that matters ultimately. So I'm not saying that a company that's cash flow negative is always a bad investment. I'm just saying that ultimately, what kind of cash are they bringing in? So you can look at cash flow from operations, and then ultimately then free cash flow, which is cash flow from operations minus capex. That's the cash. So you as a person, someone in a family or household, you're looking at how much we bring in cash money, right, after taxes, how much are we spending, and then that's what's left over. That is not how an income statement for business works. So you got to get down to the cash flow component.
Yeah. So what's a better metric for how much they're actually converting to cash? Like, are there better metrics?
Yeah. Well, cash flow is so you have the income statement, the balance sheet, and the cash flow statement. So the cash flow statement is telling you the cash numbers, right? So the income statement, the balance sheet are more guesstimates. So I mean, unless you have an outright fraud, it's usually going to be relatively close. But EPS earnings is, it's just not. It's not a total facade, but it's somewhere between a real and a facade. It's not real, it's not a facade. But so a better metric is, I think that you do want to look at growth. You want to look at revenue growth. You want to look at cash flow. But you want to look at what I said earlier, which is, and this takes more understanding, but the return on capital. So what's and I look at free cash flow for that. So you can just get that from the cash flow statement. So you look at cash flow from operations and you subtract capex. And then so you take that free cash flow and you divide it by the net operating capital. Or you could just a simple version would say you could take book value or net book tangible book value. So something like that would be a good proxy, good estimate. And just so then you divide. So the return on capital is free cash flow divided by that net worth or net capital. That's how I do it.
Okay. Yeah. Okay. So Okay, so that's very helpful. So a type of investment where I think in principle people could make, very nice convex bets, very, positive asymmetric bets would be to invest in, penny stocks. Um, do you think penny stocks should be for all types of investors, or do you think that they're too problematic, not liquid enough? Any thoughts on investing in penny stocks?
Yeah, I don't know why. Yeah, I would never do that. I would run from anybody who's recommending penny stocks. Are you recommending penny stocks, Pedro?
No, sir. No, sir. I do not.
Okay.
No,
Uh,
but some people invest in, like, micro cap funds, or you know what
well,
I'm
that's
saying?
different.
Like,
Micro cap fund. So we have kind of a barbell approach, which is not the design. Like it's not a mandate. It's not. We didn't like say, hey, we set up the strategy. Here's how we're going to do it. But it just kind of turned out this way. And that's where the big guys, the dominant big players that everybody you know their names, a few of like Facebook and Amazon, and then some like GoDaddy and Dropbox, who are, I think, very um, solidified in their space. And that's one side of the barbell. And then on the other side, we have companies that you've never heard of that are have a $200 million market cap, or a $500 million market cap, or 70 or something like that, right? So it's low liquidity, but that's based on a fundamental kind of approach. And yeah, even in that, you once you buy, if you need to get out, good luck. It's going to be hard. There's just not enough volume. So with penny stocks, the way that works is, so George Soros has this philosophy he wrote about in Alchemy of Finance called reflexivity. And reflexivity is basically outcomes are not predetermined. They happen because of actions you take. So actions that are taken, if you have enough power or influence over that domain, you can literally direct the outcome. So obviously there's uncertainty involved, and but he did this with the Bank of England. He broke the pound back in the 90s with Stanley Druckenmiller. And so with penny stocks, if a penny stock promoter can get enough people, this has happened with AMC and GameStop recently, everybody's seen, but if a penny stock promoter can get even 100 people to start buying, there's not enough liquidity there. I'm sure you already know this, but there's not enough liquidity there to have a stable price. There's not enough volume, right? So they're just gonna. It doesn't take much to skyrocket the price, but it's not based on any sort of appropriate reason. It's just based on having more buyers. So the ones who know how to play that are the those kind of shyster type penny stock promoters. More of their customers, or their whoever's listening to them, they're the ones who kind of get the raw end of the deal eventually. Most of them.
Okay. Good. And then, so, I think the other thing that worries a lot of people is, we've been expecting like a big, 2008 type crash for a very long time. I mean, I do remember the scare from 2015. Last year, the markets recovered quickly. But I think the reason a lot of the people are scared to invest in the market is, they're afraid that there's going to be another drawdown. Now, I have seen two types of approaches concerning this. Some people would recommend that you have some sort of, that you try to time your investments, maybe like just invest 25% in the market and then the rest, cash, commodities, etc. But then there's also the folks that are promoting, tail risk hedging. Do you think, I mean, would you recommend someone to learn how to do tail risk hedging? Or do you think people should, try other type approaches for tail risk hedging?
Yeah,
that they should stay invested in the market and,
I guess this goes back to a question that you asked earlier that I didn't really answer fully. It's no, they probably shouldn't try tail hedging, and they probably shouldn't try to like buy individual stock. Most people. So index funds are probably the best idea for most people. It's not like, it's not a sure thing, but it definitely has been. I wrote in 2012 that if you're going to invest in the market, you should invest in index funds. And then I stopped investing in index funds, a few years later, because I kind of think that it's become a systemic risk in a sense that so many people are doing it. How long can the central bank and the Fed keep propping up markets globally? It'll probably work until they can't do that anymore. Someday they won't be able to. So there's a lot of downside asymmetry. But that's markets, right? So you can't avoid risk. You have to take the ups and the downs. So that's the first part of it, just investing. They probably should not try tail hedging. The answer to the question is where you should invest is you should. Very few people get rich investing in markets, publicly traded secondary markets, which is what the stock market is, right? They do well because they find something that provides a service and a value to people. This is a problem that I have sometimes with what I do is I know what value I'm providing, and I think it's very important, which is capital allocation, trying to provide capital to the businesses that are most deserving, right, of that capital, and that's very important as investors. Most investors aren't doing that. Most market participants are not doing that, right? They're speculating on, like you said, penny stocks or Bitcoin or GameStop or whatever that has nothing to do with what happens in real life, right? There's no tie, there's no link between what they're doing and any sort of beneficial value that's provided to any party, except for the brokers that they're trading with, right? So find something that adds value to people. Find something that provides some sort of societal, has some sort of societal use, be useful, and build a business around that. That's the way you build wealth. And then as you do that, I think you actually have to try to do that first in order to understand that business element that then feeds into understanding companies as investments.
Okay, and and any thoughts on equally weighted funds versus market cap weighted funds?
Well, it's probably like there's nothing that is just this is the right way to do it all the time, and so indexing itself has become. Actually, Jack Bogle said one time.
Alpha Architects.
No, he's founder of Vanguard. The guy who,
of course, my bad.
The guy who popularized.
He died last year, I think.
Yeah. So he said one time, the crowd is always wrong, and whatever's popular isn't going to work. And it's funny because I don't think he or even say somebody like Buffett who started talking about people should index like in 2008 or before that. I don't think any of them thought it would become this popular, right? Because the mutual fund industry and it's a whole different conversation about why most investment funds and managers and whatnot don't do well. I actually wrote a white paper on that. That's on our front page of our website, but about why most managers don't do well. But they had such a stronghold on the entire financial services industry. Nobody was thinking about fees. It was not a thing. They did an incredible job, an exquisite job of keeping that off the radar of most, average investors. So they were charging 2.5%, 3% annually, which adds up to just it's an insane number for no value add, right? For something that's just giving you beta market access, market exposure. So I don't think they thought about how. I don't think they thought it would become so popular, but it is. So I think indexing, buying the S&P 500, just buying that, it's probably going to be okay for the I guess, but it's the downside asymmetry is just massive, Valuations at all-time highs. Everybody's doing it. If everybody's doing it in the investing world, it's like there's probably not that much benefit.
Yeah.
Right. So there's a reversion. So yeah, something like an equally weighted index is probably better. What I've been looking at more recently is looking at companies in various emerging markets or even developed countries where I'm not as familiar with or comfortable with their the regulatory setup, like Sweden or Switzerland or Italy or something like that. Is so ETFs or index funds in those areas probably give you some diversification.
Yeah. Okay, and then there's a lot of people tend to talk about discretionary funds versus funds that use systematic type strategies. And something that day traders think about a lot is kind of like, well, not day traders, but like retail people. They think a lot of in terms of, okay, I'm going to invest in this stock and then I'm going to have an exit plan, right? Like I'm going to have my stop loss order. I'm going to have my limit for, when it reaches my target price, or I'm going to hold this for a year or something. Do you think a lot about that? Like, is the risk to reward ratio in an investment something that you spend a lot of time on, or is that not that important when you're a value investor?
No, it's everything when you're a value investor, but that's totally separate from how long you're going to hold it, or what your exit strategy is. Those are totally different things. So the totally different areas. So the risk reward is everything, right? So that's what's the value to what is the value now or in the future, we think, excuse me, versus what we can buy it at today. So that's the risk reward, right?
Yeah.
And then what's the downside if things kind of don't go well? And then eventually you're going to be wrong probably half the time. So the key is, and that's the thing about, well, you got to, people think it's about being right. It's not. It's about when you figure out you're wrong, getting out. And that's a hard process, but that's the exit. When something has changed, when the risk reward is not the same, either because the stock has run up so much or because something in the fundamental business has changed, then that's the exit strategy. Now, where I got in trouble, have made just a ridiculous number of mistakes, is selling too early, selling too soon because something ran up and I thought it was expensive, but it really wasn't. Like, so if a company is doing well, you've done all this work on it, this research, and you're convinced it's doing well, and then it starts to perform well in the market, that just because the price goes up doesn't mean it's more expensive. With great companies, it's actually, I'd say, more rare that the price rising makes it more expensive. Now, that's with really good companies. Like one of the most tax inefficient things that I've ever done was this year. Very stupid, but I bought Etsy during the pandemic and then sold it because it went from like 35 to 90. And I sold it, and then it proceeded to go up to like it went up to like 200. And wow. I thought it was fairly priced or expensive at 90 or 100. But their business was just improving so much that it was a good value. Then we bought it back at 160. And on the face of it, that sounds insane, and it is, and it wasn't a smart thing to do, but it's just such a good company, and their numbers are so good. Their return on capital, their return on incrementally invested capital is so good. Their new CEO, Josh Silverman, is so good, is doing a really good job. I should have never sold it, but so that I've done that, and I can't tell you how many times. That's the first time I bought it back, like that. But I've done that quite a bit. Now, what happens more often is you figure out you were wrong about something. Either you were wrong, either you missed something, or something has changed. And that's just about being honest with yourself, So you don't want to get so tied into something emotionally that it you want to use your emotions the right way. You don't want to get so tied into something that it becomes kind of a part of your identity and you can't see when something has changed.
Yeah. Yeah. Okay. Yeah, I think that's, well, okay, one more thing. Any thoughts on using, Markovitch portfolio theory or, factor investing? Is that something that you personally use?
No, I don't use any of it. I don't get I don't get any of it. I mean, I did. I mean, I used it. I used Markowitz, Efficient Frontier for 7 years, first part of my career, because that's what everybody used. And I in my first quarter letter last year, after the crash, after the COVID-19 kind of market shakeup, I said what I noticed with the Efficient Frontier is, it said here's like the expected return of an asset class, and here's the risk and standard deviation return. And it was usually, I mean, they were using historical numbers, right? And it was never, ever, ever, so all that's based on standard deviation, correlation, betas. It was never, ever, ever what it was supposed to be. Like how it played out was always different than what it's. So I asked, why do why do we do this? And nobody had an answer. And that's still the same way. It's an ideology. So it has become these people have their entire lives tied up in this ideology and they can't get away from it, which is, it's fine. It's what, but no, I don't use any of that. And factor investing is just a new way. So what modern portfolio theory is, or was initially, is it was a way to explain markets. Okay. Factor investing is the same thing. It's a way to explain what's going on. So if we can attribute anybody's success to some factor, then we don't have to say that they know, we don't have to acknowledge that they know what they're doing. So AQR had a paper about Buffett being the greatest factor investor in the world.
Really?
And not in a good way. It's basically like he's just using factors. And it's like, all right, but there's a lot more that goes into it than that. You have to be in that moment and be able to make those decisions and be able to assess the people, because the end results, the driver is not based on factors. It's based on what decisions people make. Factors are hindsight. Factors are what happens later based on those decisions. So if you're making that, you're implicitly, you're saying that what happens in the future is going to be like what has happened in the past. And it's just, it's insane.
I think so. The first time I saw Markovitz's portfolio theories was when I took the CFA level 1. I have to confess, I failed level 2 and I haven't given it another shot, but I've recently came to realize how far from optimal Markovitz's portfolio theory is, because your returns are extremely concave to the covariances. And so what I mean by that is, for you to make your predictions, you have to, calculate your expected returns and your covariance matrix. But basically, if you get any of those wrong, right? Like basically when you're concave, what it means is when you are pessimistic, you may be pessimistic by a little bit, but when you're optimistic by a lot. And so modern portfolio theory is extremely far from optimal. So the way Taleb says it in his book is basically the returns are they're not elliptic. They are, I forgot the term, but basically, like if you got all of the correlations perfectly right, you're going to have that return. But if they move only slightly, you're actually going to be very far from that return. And so, in reality, people should probably be doing something like equal allocation. Like you're really not getting any improvements. If anything, you're normally making it worse with Markovitz. So thanks a lot for your time. I think this was really helpful, for me and for people, in the audience. I know that you wanted to, maybe discuss physics, but I don't know if you want to do it, as part of the conversation, or if you wanted to do it offline.
Well, we could do it another time. Yeah, I was going to ask about physics. I've gotten into that too a little bit here and there, but that's
Okay.
read Feynman and some Wittgenstein and
Oh, wow. Okay.
Penrose. But yeah,
Mhm.
it's interesting. It's but mainly the quantum side. I'm interested in quantum computing, and so figuring out how that works.
Yeah, I mean, I might have to read up on some of that.
We should do another
Yeah.
time and maybe get Trushenko on. He's got a lot of knowledge and a lot of kind of he's got a lot of strong assertions, and he's usually right. He corrects me on things that I say wrong and about that. I mean, that's he's one of the he's one of the most knowledgeable people in that space that I know. And but yeah, that's all very interesting. The quantum computing arena could change everything pretty fast, so if they figure it out.
Yeah, maybe. I have a friend who I might invite on who's doing that at Google.
Yeah, he'd
But
be great
okay,
to talk to.
final question. So is there a book, or maybe a talk on YouTube, anything that you think people who want to invest should definitely check out?
What I tell people is, so I say, if you want to learn investing, you just watch all of the Berkshire annual meetings. And so there's lots of Buffett and Munger acolytes or sycophants or whatever fans, and most of them are good natured. But I'm seeing a lot more of this kind of it's like a trinket to sell. Like I wrote a book about Buffett, and I mean they're coming out like every day. Every week there's a new book about something about Buffett, and some are really good. But if you just watch those videos, those annual meeting videos, it takes a while, right? I think like it's like 20 years worth of annual meetings, and they're each probably 3 to 4 hours of them just talking and answering questions. That's invaluable, and I think what a lot of investors or complexity thinkers or brewery graduates miss, or whatever, is the overlap between what you could say. I call it Munger and Taleb, but really it's like Buffett, Munger, Taleb, Spitznagel. The overlap of what they're talking about is huge, but I think most people just miss it. They just don't. It's not. None of they never come out and say, "Hey, we're saying the same thing here." Buffett's never. Taleb says this, and that's what I'm saying here. But it's obvious that there's similarities. So. And overlap. So I think those two kind of philosophies are most important for kind of being a market participant in 21st century.
Yeah. So I'm reading Peter Bevelin.
Yeah.
So the book is called Seeking Wisdom. It's a Charlie Munger.
No, that's
book.
good. It's a really good book. It's a really good one. Yeah.
Yeah. I mean, I think definitely they seem to understand a lot of complexity. They seem to understand complexity intuitively, right? Like they don't call it that, but when Charlie Munger says, "I'm not focusing on being really smart, I'm mostly focusing on not doing something really stupid," right? Like that's something that Taleb talks about all the time too, right? Like you should avoid a huge loss. Like that should be your number one priority.
Yeah, I think it goes against human nature or something. I mean, most people just want some sort of specific, this is what you do. They want some sort of concrete answer. And the answer is what you said, like try not to be stupid. It's that's the thing. So that's a good one. All those good ones can there's a couple more recent ones that are good too, but most of the good ones were written at least a few years ago. The Warren Buffett portfolio, Robert Haugstrom, I think so you say his last name, is he's written like 10 Buffett books, but the one that I found that and so has this guy named Lawrence Cunningham, and they're all pretty good, but I think it's Warren Buffett Portfolio was written in like 99 or 2000 or 2001, and it's really good. And something I learned there is they were talking about adaptive markets. Haugstrom uses the term adaptive markets. I've got it somewhere. Yeah, I've got it right here. This, yeah, Haugstrom. He uses the term adaptive markets, right? Complex adaptive markets. Because that's how it was described to him by Buffett and Munger, or how they talked about it in one of their meetings. And then it turns out this guy, Andrew Lowe at MIT, comes up with this theory called adaptive markets hypothesis. And so it just is another kind of indicator that none of these academics are not coming up with anything new. They're just taking what people already use and then making a theory out of it.
Right. All right, cool. Well, thanks a lot, Chase. And you're always welcome here. I really appreciate you, giving me the opportunity.
Yeah, thanks, Pedro.
All right.